So the ESOP really starts at inception, where the company is levered potentially up to 100%, and the focus is really on paying down the debt as part of the transaction. Over the first few years, the debt levels become more manageable, and the ESOP can now start focusing on potentially balancing excess free cash flow to paying down transaction debt or reinvesting in potential opportunities for growth, buying new business units, acquiring a company, and other items like that. The further out you go, kind of in this C position, free cash flow continues to increase, debt service continues to decrease, but we introduce the repurchase obligation. We're far enough out from the transaction where this can start becoming, a source or a use of cash for the ESOP company. But there's still a balance. The ESOP company may not want to only sit where it is. There may be acquisitions, reinvestment, but that has to be balanced with what does that mean for ESOP participants today and in the future? How do we leverage capital markets or our internal sources of cash to fund those acquisitions and growth opportunities while maintaining our ability to fund our repurchase obligation? And then when we get to this final stage, or stage D, as a mature ESOP, this was where we may run into issues, which is where the repurchase obligation is becoming such a huge burden on the cash flows that the company is no longer able to support the repurchase obligation, its reinvestment in any debt service with its internally generated cash flows. And so how do we manage that long term? And we can look to capital markets to be able to bridge some gaps, to fund our growth opportunities, or to manage our repurchase obligations.
As you look at the relative cost of capital from these various providers, there's a wide range of costs and types of cash carry on various debt instruments and equity instruments. Some of these are senior, some of these are professional mezzanine, some of them are seller notes. What I've tried to highlight here on this screen is the relative interest and cost of carrying these investment items, whether it's debt or equity, how that is structured with an underlying rate and a cash spread, and where the equity components come in. So as you look across the chart from left to right, we've got the asset-based lenders who will typically lend at a cost of funds, SOFR, the secured overnight funding rate, if you will, with a spread attached to it. Now, you might be surprised that some of these asset-based lenders are very inexpensive relative to other forms of capital. And a lot of that lies in the security that they have. The asset-based lender will be very dependent on assets to get themselves out whole. And if you think about it in terms of how we're going to get out, well, me as an investment banker, I could probably sell a coil of steel pretty easily. I might have more difficulty collecting from a foreign entity. So when you look at the asset-based lender, he is going to lend against the specific assets which have the greatest liquidation value and the greatest comfort to him that if he has to lend against that, he's going to come out whole. The second bucket, the senior cash flow loans, think of these as the bank's blue chip clients. These are the ones that are selling hundreds of millions of dollars in revenues a year, strong EBITDA, consistent, multiple divisions, multiple operating units, where the bank just pretty much says, here, take the money, go do what you want with it. I'm not going to worry about you. It's so bankruptcy remote that it's the blue chip of the blue chip. You move from there to senior secured. Most of the ESOP debt that we see today, actually most middle market debt that we see today, is senior secured. Now, there may not be sufficient collateral coverage to fully secure the loan at closing, but this is a situation where you look at that teeter-totter, there's good cash flow and there's good assets. Where the assets are short, the bank is reasonably comfortable that within 18 months, you're going to be back into a collateral formula. So again, we get a little bit further away from that blue chip. We don't have the full asset coverage, but it's a senior secured loan, and that's what is most typical. The next bucket, the seller subordinated notes, you'll notice that we have cash of the SOFR rate plus the spread. Typically, this might be a fixed rate in the seller note, but then the seller's also got a warrant position on top of that. As you look across this chart, the green boxes, the equity pieces, are typically non-cash in nature on an ongoing basis, but they will have to be realized at some point in the future. So we need to keep that in mind. While equity seems free from a cash flow standpoint, it does come due. We move across the spread a little bit further, professional mezzanine. Typically a little bit higher spread than the seller subordinated notes, a higher return. And that's often because the seller subordinated note is not run by the mezzanine fund. It's still run by management. There's a difference. There's no skeletons in the closet for management. For the professional mezzanine guys, there might be. And then finally, we move on to preferred stock and equity and those instruments that are a little bit further out along the curve.
Dick, one point on this slide that you mentioned that I think is important to understand from a cost standpoint is that equity does come due. And I think we think of equity investments sometimes as the company getting cash, but that cash ultimately will be removed from the business by an investor at some point. And so the cost associated with that is their expected return versus on the debt side, it really is a cash interest. And I know it may be a relatively, elementary concept of cash interest versus the equity return, but that's what we mean by the cost of equity. And that's why it's so expensive, because there is no backing. And so an investor can take their money at any time if the company is not reaching that cost, or they're reaching it even better than they expected.
Yeah, Joseph, you hit on a good point there. When you look at those green boxes, the equity-like components of these, each one of those presents a refinancing risk. On the seller notes at year 7 or 10 when they come due, you're going to have some warrants that you're going to have to take out. Hopefully there's cash flow to do that, but it might be that you have to go back to the bank markets for that. If you go all the way across to the common stock and the equity side, and think about the extreme where you have a private equity fund putting the money in, that fund is going to want its money back in years 5, 6, or 7, and they'll need a plan to get that back before they get in. They'll have alternative exits at the back end. Some of those might be the ultimate sale of the company. But there is a risk of refinancing in all of those green boxes. So when we look at the spectrum on this slide of capital types, moving down from the strength and predictability of cash flows to the not so predictable cash flows, and what instruments are typically applied. That blue chip company I talked about early on when the bank says, take the money, go do what you're going to do. I'm so far bankruptcy remote. He is very strong in cash flows, typically multiple independent exits. It might be the liquidation of assets. It might be refinancing. It might be the sale of a division, but many, many ways out. That's the easy one. When we look at mid-market, typically we're seeing senior cash flow secured loans. Collateral might be pretty good, but you want it to get better along the way. That's pretty much what we see in most of the ESOP market from the onset. That's the go-to typical bank financing. There's specified use assets of loans. So picture a mortgage facility or an equipment facility. Assets are typically pretty good support on this one. So it works out typically because you've got good asset support, you can have a longer maturity as well. And then senior asset-based situation where we have light cash flows and strong assets, obviously the best cash asset coverage. And then we get down to the mezzanine in the equity side where there may not be asset coverage and there may not be cash flows. We need something to happen, an event in the future to get us out. But this gives you a good range of what types of financing and capital are available out there.